Good morning and welcome to Markets Cafe here on ET Now with me Lisa Fernandez, and I have with me my colleague Snehi Shah. Good morning, Snehi.
Good morning, Lisa.
And this is the show where we take you through all that will be in focus today on the back of news, announcements, both on the international as well as the domestic front. We will be coming on the domestic front in the latter part of the show, where we'll be discussing on the stocks that you have to keep in focus today, that you have to keep an eye on the back of brokerages, announcements. But now we'll move on to the international front, and Snehi has tracked the international market closely.
Yes.
Snehi, the selling pressure that intensified in the US market, and that was on the back of the Fitch rate downgrading. But the Treasury Secretary Yellen and even analysts are saying that this actually does not matter much, and this is just a temporary blip.
Absolutely, Lisa. Good morning to you and good morning to all our viewers. As Lisa pointed out, Janet Yellen has also called this move arbitrary. But let's also look at what the US markets did after the rating cut that came in. And stock futures were little changed on Wednesday as traders contended with Fitch's recent downgrade of the United States long-term rating. And futures tied to all three indices saw very marginal upticks. Now remember, Fitch Ratings has cut the United States long-term foreign currency issuer default rating to AA+ from AAA. Now, Wednesday's regular trading session saw a steep sell-off that weighed the tech-heavy Nasdaq composite down by more than 2%. It marked the worst day since February for Nasdaq as tech stocks tumbled amid a spike in bond yields. Both the S&P 500 as well as the Dow Jones Industrial Average also closed lower. And investors are turning their focus on Thursday to tech bellwether Apple as well as e-commerce giant Amazon, as both will be posting their results after markets close. In the way of economic data, traders will also be gearing up for the weekly initial jobless claims as well as durable goods orders. Now, the main event will be Friday's July payrolls report. So this is what the US market looked like. Futures largely unchanged, but regular trading, all three indices seeing sharp cuts. Let's move on to Europe then, and European stock markets fell on Wednesday as global sentiment was pulled down because of that US credit rating downgrade. Now, the Pan-European Stock 600 index closed with a downtick of 1.3%, with all the sectors and bosses in the negative territory. Mining and retail stocks were the biggest downward pressures on the index, both down around 2.7%. The Stock 600 index fell for a second consecutive session on Wednesday to more than a two-week low. Germany's DAX and the UK's FTSE 100 both declined by around 1.3% as well, whereas France's CAC CAC 40 dropped by 1.2%. So this is what the global handover is looking like, largely negative, coming from both US as well as Europe. But while this is on the equity front, Lisa, also take us through what oil did.
Well, yes. So actually it was anticipated that oil prices will move up, but actually it edged down lower, and this was despite the historic drop that we saw in the US crude stocks. And this was because the traders are de-risking following the downgrade of the US government's top credit by the rating agencies. The US crude stocks, remember, it fell in the week by 17 million barrels, the largest drop in the US crude inventories, and this is according to records dating back to 1982. And also additionally, US government has pulled an offer to buy 6 million barrels of oil for this that is from the strategic petroleum reserve. That has also pushed the prices lower, traders and analysts are saying. So the crude oil inventories, they have begun to drop in other regions also, as demand is outpacing the supply, and that has been constrained by the deep production cuts from Saudi Arabia. Now, concerns have also arisen that the oil buying in China, which is the world's biggest oil importer, that may slow down as the prices rise, because even the PMI data that came in, that was quite weak. Now, the OPEC that will meet on Friday, they are unlikely to revise their current oil output policy. So let's look at what crude prices are doing now. The WTI crude, that is flat, but it's trading with a positive bias. It's at $79.6 per barrel. Even Brent crude, that stands at around $83.34 per barrel. Talking about the gold prices, that has retreated lower. It's at 1,972 an ounce, and that is because of the US dollar as well as bond yields that has resumed its climb. The US 10-year Treasury yield, that has hit the highest level since November, and it has topped 4.09%. So that's on the crude as well as other commodities check.
Absolutely, and with that, let's also look at all the important cues that you should be tracking throughout today. And let's look at the global cues then. And for UK, you've got the Bank of England rate decision, which will come out today. Analysts are expecting a hike, so we will watch out for that one. When it comes to the Indian markets, you've got the weekly expiry today. Today is a Thursday, so it's a weekly expiry day. On the corporate action front, you've got the boards of Blue Star as well as HCC, which is Hindustan Construction Company. The boards of these companies will consider fundraising today. And when it comes to the action on the primary markets then, in the IPO space, you've got SBFC Finance, whose IPO will open for subscription today. So keep an eye out on all these cues to track in today's trading session.
And now moving on to other global stories, the Fitch rating downgrade of the United States long-term credit rating. Ultimately, it doesn't matter, says JP Morgan Chase CEO Jamie Dimon. He adds that it does not matter all that much because he believes that it's the market and not the rating agencies that determines borrowing cost. And not just this, he also called the move ridiculous. And financial markets across the globe were treated with quite a surprise after global credit rating agency Fitch downgraded US sovereign rating from AAA to AA+. Now let's hear out a take from experts on what they make out of the move and the road ahead for the markets.
In isolation, even within US, I think the question is, almost every investor knows, and people are talking about it openly, that when will the government really talk about this elephant in the room? They spend 50 to 55% on entitlement programs, which are largely about pensions, which is social security. It's funded a little differently than other countries, but that's where it is. And the healthcare spending on Medicare, Medicaid. And as the baby boomers rise in numbers and the people employed, the number drops, I think it's going to be very unsustainable. And I think that's what the drop in governance standards that Moodys is talking about, that look, no party is willing to talk to people about some tough fiscal discipline, right? And if nobody is going to do it, then ultimately we know what's going to happen. Inflation will be persisting, and government will try to take it easy with inflating away the debt burden.
I don't think so, but I do think we're still headed for a recession. Obviously not here, not in 2023, but perhaps at the first or second quarter of 2024. I have never experienced where the Feds raise for almost a year consecutively, and the economy didn't end up in recession. This is a peculiar situation, and I think the reason for that is because of the pandemic.
All right, shifting focus then, UBS has begun laying off employees from Credit Suisse this week. The scale of layoffs is still unknown, but sources suggest that UBS has decided to close Credit Suisse's Houston office. The office in Houston used to lead business with the oil industry, which will now be covered by New York.
Shifting gears to some global earnings now, chip maker Qualcomm has reported a staggering 52% decline in their net income. Company's guidance for the coming quarter also fell short. The stock, it took a 6% hit in after-hours trade. Meanwhile, payments firm PayPal has delivered a disappointing operating margin in Q3, even as executives are hinting towards an improvement at the end of the year. Company's margin came in at 21.4%, missing that 22% estimate.
Staying with earnings then, Singapore's biggest bank DBS Group reported its Q2 earnings with its profit jumping 48%, which beat forecasts as higher interest rates helped to drive income growth. The bank said that the outlook for net interest margin has improved due to unexpected US interest rate increases in the second half.
And with that, let's slip into a short break. More news and updates on the other side of the break, so stay tuned on the channel.
there, welcome back and thanks for staying tuned to Market Cafe. Before we move on with the show, let's also look at what the Asian Pacific markets are doing. And these markets are extending their losses on Thursday as we speak, as they're tracking Wall Street's sell-off following the rating cut that came in from Fitch. Now in Asia, investors will be watching the Caixin private survey for China's service sector activity in July. Let's look at what Nikkei is doing. Nikkei taking a sharp cut of 1.1% in trade as of now, trading with a downtick of almost 370 points. Followed by that, you've also got other indices in Asia. You've got Kospi. Kospi is seeming to hold on well, down with very minor downtick, just 4% coming over there. 4 points coming over there, pardon me, just 0.1% lower in trade. Followed by that, Hang Seng, you've got 43 points lower in trade, 0.2% lower in trade, also seeming to be holding on, but in the red nonetheless. Followed by that, Shanghai also at similar levels, trading with a downtick of 0.1%. Let's also look at what ASX 200 is doing then. Australia's index, that's down with almost 0.4%, down 33 points in this trading session as we speak. Australia will also be releasing its trade balance for the month of June, so you can see how that's pairing on that index. Followed by that, you've got the GIFT Nifty, which is up 24 points, up 0.1%, indicating a flat start but with a slight positive bias for our market. So let's see how that pans out for us this morning.
Good morning and welcome. And now the GST Council, the outcome has come out on the online gaming meet, where the GST Council has decided to keep the 28% GST on the online gaming. They have maintained the rate and the tax will be levied on entry-level amounts. And this is as opposed to the fair taxation on every bet. So FM Sitaraman has also shared how the council is aiming to implement the tax by October 1st of this year and has come back to review it in the following 6 months. So listen in to an expert of this.
Valuation of supply of online gaming and actionable claims in casinos may be done based on the amount paid or payable to or deposited with the supplier by or on behalf of the player, excluding the amount entered into games, bets out of winnings of previous games and bets, and not on the total value of each bet placed. Entry, whatever they pay to get, let's say, the chips, will be the amount, but not on what they pay in each game. So one simple example that I can give you is 1,000 rupees is given, chips are taken, you go into the casino, you pay the first 100 and play. In case you win something, you've got a 300 in your hand, which means net is 1,300. That 300 doesn't get taxed. It is the 1,000 that you get yourselves taxed. 1st October is when it is expected, by which time the states also will pass their amendments to their state laws. And because on the casino, Goa and Sikkim kept appealing, saying we are small states, we need to be given a consideration. Andhra Pradesh FM also said we should have large heart and help out small states. The council agreed today to come back after 6 months to review the way in which this is getting implemented. When I say 6 months, it's not 6 consecutive months beginning from today. It begins from after when this gets implemented. 6 months of implementation hopefully will give us some inputs, and also we can share our experiences to see how it is going on.
All right, that's the word coming in from the Finance Minister Nirmala Sitharaman. But let's also go across to my colleague Prakash Priyadarshi to get us more details on this. Prakash?
The GST Council has approved wider framework to levy 28% GST on full face value in the context of online gaming casino. However, GST Council has decided to keep 28% GST on full face value unchanged as it was decided in its last meeting. But the Council has come out with clarification as to how 28% GST would be levied. As per the Council's decision, 28% GST on full face value would be charged on entry level, not every bed. That is something where clarity was needed. So it may provide a relief to the online gaming companies as well as GST would be charged on entry level. However, it was not an unanimous decision of the GST Council, as some states had apprehension on some of the provisions, considering that GST Council has decided to review this overall framework in next 6 months, and the government is hopeful to implement this framework from 1st October 2023. In addition to that, GST Council has also approved a wider framework, a wider definition of online gaming. A new definition of online money gaming has been included under online gaming category. Deposit of money by a player, including digital assets, virtual currency, can be considered as online money gaming. Apart from that, when it comes to the issue that is with regard to overseas online gaming platforms, GST Council has decided to make it mandatory for overseas online gaming platforms to register themselves in the country.
And now shifting focus on some earning candidates, airline major Interglobe Aviation, as we know as Indigo, has posted a solid set of numbers for the quarter gone by. Sequentially, the first quarter profit has more than tripled to a little under 3,100 crore, while revenue has jumped 18%. Somit is here with all the numbers and to break down the numbers for us. Over to you, Somit.
Well, it was a blockbuster quarter for Indigo. Well, net profit for the first quarter came in at close to 3,100 crore rupees, which is way more than the highest net profit annual net profit reported by the company back in FY18 at close to 2,240 crore rupees. EBITDA jumped by nearly 94% on a sequential basis, while revenues were higher by 18%. So what were the factors that aided the first quarter numbers? Well, it was the higher air traffic, higher yields, which measure the average fare per passenger per kilometer, higher passenger load factor, which is capacity utilization, and lower oil prices, and a stable INR that led to this blockbuster quarter for Indigo in the first quarter of FY24. Now, for the second quarter also, the company is expecting their capacity to grow by around 6% on a sequential basis. However, if you see, the yields are on a falling trend, and that is what the management has clearly said, and that is the biggest concern now for the street, and they are saying that the yields are not only down on a Q-on-Q basis but also on a YOY basis. They are expecting the decline in yields to be in the teens. That could be anywhere between 13 to 19%. So that's a big kind of a fall that is expected in the yields, and that could be the major overhang. In fact, Goldman Sachs has gone ahead and said that in the second quarter, the company might as well report a loss after reporting a strong profit in the first quarter. So that is the biggest concern now on the street, though the first quarter numbers were very good and way ahead of what the street was expecting. So do watch out for Indigo.
All right, Swami, thanks for all those details. Blockbuster quarter indeed coming in for Indigo. But let's also look at what the brokerages are spotting for this stock. We've got notes coming in from Goldman Sachs and Bank of America this morning. So let's start with the one from Goldman Sachs then. And the brokerage has maintained a buy on the stock, but has cut the target from 2,730 rupees to 2,600 rupees per share now. They say that quarter one was in line, but they're expecting a weak quarter two outlook. And they say that all eyes will be on the quarter three results on the back of the Cricket World Cup happening in India. And they also say that Indigo is likely to make a loss in the second quarter. On the other hand, their long-term fundamentals remain intact. But they've gone ahead and cut the FY25, FY26 PBT by 9% and 7% respectively on lower yield assumptions. Moving on then, let's also see what Bank of America is saying on Indigo. And this brokerage has maintained a buy on the stock with a target of 2,900 rupees per share. They say that record quarterly profits have arrived for Indigo, but they say that the soft quarter two yield guide is disappointing. They've also gone ahead and said that yields must stabilize beyond the second quarter to drive a re-rating in the stock. They have hiked the FY24 estimates on strong quarter one, and lower valuation multiples and 2-year EPS CAGR will also be in focus. On this note, let's also go across and listen into what the management had to say on their con call.
For the quarter ended June 2023, the total revenue increased by around 32% on a year-over-year basis. Our unit revenue came in at 5.12 rupees, which is around 9% higher compared to the quarter ended June 2022. While the yields came in stronger than expected and remained flattish compared to the quarter ended June 2022, the load factor increased by 9 points, leading to this growth in the unit revenues. On the cost side, the fuel CASK reduced by around 26.6%, primarily due to reduction in average fuel prices. Further, the rupee closed slightly stronger at the quarter end, leading to a forex gain of around 1.2 billion rupees. Excluding the impact of forex and fuel, the CASK ex-fuel, ex-forex has increased by around 9% compared to the first quarter of fiscal year 2023, primarily driven by annual contractual escalation and inflationary cost pressures.
So while it was a strong quarter for Indigo, it was quite the reverse for Gujarat Gas, as Gujarat Gas reported the biggest ever miss to the consensus estimates, and the profits has dipped 42% on sequential basis. Poor margins in the Morbi region that hurt quarter one. Somit is here joining with more details on this. Somit.
It was a howler for Gujarat Gas in the first quarter of FY24, as we were seeing that it is the biggest ever miss to analyst estimate on the EBITDA front that Gujarat Gas has reported in the first quarter. The revenues were down nearly 4%, EBITDA declined by nearly 31%. The EBITDA number came in at close to 388 crore rupees, while analysts were expecting the EBITDA to be close to 550 crore rupees. The net profit has declined around 42% on a sequential basis. However, on the positive side, the volumes were up around 4% on a sequential basis. Now, this huge miss in the EBITDA front was largely on the fact that the company had embarked upon the strategy to focus more on volumes rather than value, and that's the reason why the EBITDA front or the per unit EBITDA of the company has also declined sharply on a sequential basis, and this was because of higher gas costs, but the company had to cut the gas prices, because of which the margins have been impacted. However, the volumes have also not given such a good return. In fact, the volumes were still below than what the street was expecting in the first quarter of FY24. Now, the company also said that they have signed around 0.4 MMSCMD of volumes in the month of June, which is yet to be commissioned. So that is another possible uptick coming in on the volume side from the second quarter of FY24. The company also said that they're looking to invest close to 100 crore rupees in GSPC LNG, but more rationale regarding this investment needs to be known, and and the company will also be holding their first ever conference call today at 4 p.m. So that's the clarity required from the company on why they are doing this investment, why the EBITDA has declined, and what is their volume outlook and strategy going forward. So keep an eye out for Gujarat Gas and Trade.
Thanks for those details. A disappointing set coming for Gujarat Gas and for quarter one. But quarter one has turned out to be a muted quarter for another company, and that is Titan. The watch and accessories maker saw its profit fall 2% on a year-on-year basis to 777 crore rupees, missing analyst expectations. Let's go across to Winnie Motiwala for all the number crunching. Winnie, take us through Titan's numbers.
So Titan's Q1 numbers clearly not shining bright as any jewelry that they sell, and a miss coming in, especially on the margin front as well as the bottom line. That's the profitability front of the company. Revenue growth came in at around 24% for the year. In terms of demand trends, the company did highlight that Akshaya Tritiya was one of the things that supported the growth, and other than that, May was a bit subdued, but June again saw a recovery because of the wedding season dates coming in. When you look at the margins, sharp miss over there, and margins just came in at 9.9% versus 12.9% last year. So contraction of around 300 basis points in terms of the margins of the company, and overall the EBIT margins, when you look at that front also for all the different segments, that is jewelry segment, watches, wearable and eye care segment, all of them have seen a decline coming in all the three segments in terms of the margins of the company as well. Now obviously what is impacting is that the gold prices volatility that was there, plus the company had given a lot of promotions in terms of to fight the competition because of this gold price volatility. There was a gold program exchange as well which took place as well, and which was the reason that we saw the impact coming in on the margins of the company. Other than that, when you look at it, the commentary that has come in, they said that they are pursuing to gain market share across categories. They remain optimistic in terms of the performance for the rest of the year, and in the con call they also highlighted that they are expecting festive season, wedding season to actually start supporting the growth in the second half of FY24. They expect the demand, and what they saw in terms of demand trends in July also was stable demand trends as much as they saw in June, not a bad demand that they saw coming in July as well. They are giving a target of 10% market share in the jewelry business in the next 3 to 4 years, and jewelry margins, they expect that to be at 12 to 13%. They are expecting and maintaining that guidance of 12% jewelry margin for the year as well. So keeping an eye out on that one. HSBC as of now has cut the target price for Titan, given the new target price at 3,580 rupees per share from previous target price of 3,600 rupees per share, and they are maintaining a buy on the stock given that we are seeing a miss coming in the margin front for the company.
Thank you, Vinny, for sharing Titan's earnings as well as the outlook. It looks like it won't be shining in trade today. But moving on, Life Insurance Corporation promoted LIC Mutual Fund is looking to double its AUM in the next 3 years to 50,000 crore rupees. This is in the first interaction after acquisition of IDBI's mutual fund portfolio. Its MD as well as CEO T.S. Ramakrishnan said that the mutual fund house will be gaining 3,700 crore AUM due to this acquisition. Well, let's listen into it.
Definitely the addition of the mutual fund schemes. We have taken over the schemes of the IDBI mutual fund, and the addition is to the tune of around 3,700 CR, to the AUM, which takes our AUM from say 19.5 to 23. And in fact, in the last 2 days, we are touching now 24, rather across 24, I will say. The good part is that out of the 3,700 CR that is coming from IDBI, schemes, a major portion is in the equity segment. Roughly around 2,800 CR is in the equity segment. So that, gives an aggressive push to our equity AUM.
Regarding the TER issue, I mean, there has been a consultation paper which was taken back, and now a fresh consultation paper is expected very soon. I want to understand in the policy context, how do you see it?
I think SEBI has yet to come out with the revised version. So when it comes, we will see. I think the chairperson of SEBI herself had mentioned that the revised version of the TER will be something which is much better than the original version. So let it come, and then we need to go through it.
All right, with that, let's quickly slip into a very short break then. But on the other side, we will look at what stocks you should be keeping on your radar this morning. We'll be right back.
Welcome back to the show, and this is where we take you through all the stocks that will be in focus, that will be in news, and we have Ansh in the studio with us who will take us through all these stocks. Ansh?
Sure. So let's start with few earnings which had come yesterday post-market. Starting with Gujarat Gas, revenue is down by 3.7% on quarter-on-quarter basis, whereas the EBITDA is down by 31%, which in turn is dragging the net profit down by 42%. In addition to that, company has approved equity investment of 100 crore in GSPC LNG. Moving on to Mankind Pharma, revenue is up by 18% on year-on-year basis. The expenses have also increased, but at a lower pace as compared to revenue number. That's why we are seeing a net profit jump of over 66%. HPCL's net revenue is up by over 4% on quarter-on-quarter basis. The EBITDA has doubled, and the net profit has also almost doubled. It is up by 93%. Sheela Foam's revenue is down by 8% on year-on-year basis, but at the same time, the expenses are also down by 12%. So company has managed to make a net profit which is about 2% higher. Pradeep Phosphate's revenue is up by 25%. However, the company has not been able to convert it into a positive profit. They have actually incurred loss of around 120 crore. Lastly, Quest Corp will be in focus as their revenue is up by 16%, EBITDA is flat, and net profit is down by 29%.
All right, thanks Ansh for all those details. We will be keeping all these stocks on our radar this morning. But with rising debt and promoter holding near 70%, Vedanta promoter Twinstar is looking to sell stake worth up to $500 million. Now this could be done via blocks at a discount of 5% to current market price. And we've also got Ashesha joining in with more details on this block deal happening. Ashesha?
Well, yes, Vedanta will be in focus on the back of that block deal, which is expected to happen today, where promoter entity Twin Star is looking to sell about 4.3% stake in the company. This could happen at about 258 rupees per share, which is a 5% discount to yesterday's closing price. Now, remember, this is not the first time that the promoter entity has been selling stake this year. They sold about 1.6% stake in the January to March quarter, and now they will be selling additional 4.3% stake in order to pare down parent company Vedanta Resources debt. Now, the debt of Vedanta Resources has been a concern for the last many quarters. They have about $2.2 billion outstanding for the remainder of FY24. They already paid $1 billion in the first quarter, and they still have liabilities left for the part of the year, because of which they are selling down their stake in order to repay those debt obligations. Important to note that Vedanta Limited, the listed entity, has also been facing some concerns with respect to their debt position. Their debt as on 31st of March stood at about 45,000 odd crores, and it rose to 60,000 crores at the end of June quarter. So Vedanta Limited's debt has also been a concern for the last many quarters. In order to pare down Vedanta Resources debt, the company has already resorted to several options, the likes of elevated dividends from Vedanta Limited, and also they also went ahead and hiked royalty that was being paid by Hindustan Zinc as well as Vedanta. Yes, of course, the stock will be in focus today on account of the block deal that is expected to happen. About 4.3% will be on the block today.
Thank you, Ashesha, for giving us and sharing us the perspective on Vedanta's block deal. The floor price set at 5% to the CMP. But moving on to Sun Pharma, they are all set to report Q1 results. Srishti is here to tell us what the street is penciling in and what to expect from Sun Pharma.
So from Sun Pharma, we are expecting a decent jump on a quarter-on-quarter as well as on a YOY basis, and that will be on the back of support coming in from the India sales as well as the US sales front. Let's talking about the numbers. Revenue is expected to be up 7% on a quarter-on-quarter basis. 11,679 crores is the expectation. EBITDA expected at 3,072 crores, while the margins expected to be up at 26.3% versus 25.6% in Q4, and the profit expected to see a jump of 13% on a quarter-on-quarter basis at 2,240 crores. So on all the parameters, we are expecting a healthy jump that will be on the back of a growth in the India business, and we are expecting a jump of 9% on a quarter-on-quarter basis. 3,658 crores is the market expectation this time. Coming to the US sales, there too a jump of mega 3% is what we are expecting. $450 million is the expectation, and that will be on the back of traction in the specialty portfolio from the likes of Illumia and the benefits coming in from G Revlimid. But higher R&D spend and Mohali consent decree may keep the margins in check. That's why we are not expecting a major push on that front. So these are the expectations from Sun Pharma, but the key to note will be the new product launches that are planned out by the company and how are they looking at the US business outlook going ahead, maybe in the 12 to 18 months time period. Back to you.
Alright, Shrishti, for all those details, we will be keeping an eye on Sun Pharma today, but we've got another company and a telecom major, Bharti Airtel, that will be declaring its Q1 numbers today. Let me take you through what the street is penciling in, and we're seeing consolidated revenue is expected to see an uptick of 2.4% on a sequential basis to come in at rupees 36,869 crore versus the 36,009 crore seen in the previous quarter. Net profit, however, is seen down 5% at 2,861 crore versus the 3,006 crores on a sequential basis. EBITDA is expected to see a rise of 3.2%, and EBITDA margins are also seeing a slight bit of an expansion at 52.3% versus the 51.9% last quarter. So this is what the street is largely penciling in. Let's also look at the India mobile business then, and revenue is expected to come in at 20,133 crores, an uptick of 3% on a sequential basis. And EBITDA also expected to come in at 10,849 crore, yet again an uptick of 3% on a sequential basis. Now, what can you expect from Bharti Airtel's numbers and the company for the Q1? Subscriber base is seen at 33.76 crore versus 33.54 crore, slight uptick coming there. ARPU is seen up 2.4% to 198 versus rupees 193. And console growth led by India mobile business, and India mobile business is also expected to grow. Marginal subscriber addition and higher ARPU is expected to come in, and subscriber addition is expected to be the lowest in the last 3 quarters for this telecom major. Now, higher ARPU will be owing to premiumization from 2G to 4G and full implementation of minimum recharge plans. Robust revenue traction in broadband and enterprise will also be seen. DTH is expected to be flat on a sequential basis, and Africa business has reported its strong set of numbers. Naira devaluation to have a 5 to 6% impact on the top line as well as the bottom line of Airtel. Lastly, the factors to watch, we need to keep an eye out on the response to Jio Bharat, as well as market share shifts, the 5G rollout, early trends from the initial 5G rollout, as well as the capex outlay. So we will be tracking this stock and trade today, all set to declare its Q1 numbers.
And Morgan Stanley has come out with a note on India and other emerging markets. Where is India placed versus the other emerging markets in Morgan Stanley's strategy? What is Morgan Stanley's outlook on India? Vamakshi is joining us with all the details. Good morning, Vamakshi. Take us through this.
Well, yes, Morgan Stanley has in fact gone ahead and upgraded its rating on India to overweight for the secular leadership. As far as the stocks are concerned, they've added L&T and Maruti to their focus list, but they've removed Titan from their focus list. Now, let's look at what their views are on India. As far as India is concerned, the rank has risen from rank 6 to rank 1, and this is because the valuations that we saw, the relative valuations, look extreme than in October. Multipolar world trends are supporting FDI as well as portfolio flows, and in fact they believe that India is adding a reform and macro stability agenda that underpins a very strong capex and profit outlook. They're seeing some secular trend towards sustained superior EPS growth versus the other emerging markets over the next cycle, and in fact they also believe that the young demographic profile is supporting the India equity flows. They believe that India is arguably at the start of a long wave of boom. At the same time, China may be ending one. India's future looks to a significant extent like China's past, and they believe that they believe that India's weightage will be introduced at nearly 75 basis points. So all in all, they've upgraded India industrials. They stay overweight on India financials and consumer discretionary, and they believe that these 3 sectors will be the major beneficiaries of India's structural story.
Well, Vamakshi, thanks for all those details, but stay with us then, and let's also look at M&M Finance's July business update, where the gross disbursements for the month remained healthy and collection efficiency has also improved. So, Vamakshi, take us through this and break this down for us.
Well, yes, let's first look at that gross disbursement number. It has remained healthy for the month, standing at 4,400 odd crores. An uptick of almost 12% is what we're seeing on a year-on-year basis, and not just that, 3.5% uptick on a month-on-month basis is what the company has reported. And this is despite July generally remaining a seasonally weak quarter. As a result, total business assets stood at 88,100 odd crores, an uptick of almost 29% on a year-on-year basis, and month-on-month uptick of almost 1.7%. And this was mainly backed by healthy disbursements as well as normalized repayments. The collection efficiency for the month also improved to 96% versus the last quarter average of 94%. And in fact, they're expecting the improvement in stage 3 assets to continue ahead. We also have a note coming in from Morgan Stanley, and they have maintained their equal weight call with a target price of 300 rupees per share. They have also highlighted that disbursements and collections have remained strong in July. The collection efficiency, in their opinion, was also marginally better. The steady stage 3 ratio on a quarter-on-quarter basis is also a positive. So all in all, July was a good update as far as M&M Financial is concerned.
Thank you, Vamakshi. But with that, it's a wrap on this edition of Market Cafe. But do stay tuned on the channel because a lot of action coming in on our next market. A lot of important important management interviews lined up for you. So stay tuned on the channel. It's a goodbye from me as well as Snehi. Thank you for watching the show.